Ladies and gentlemen, good day and welcome to the Q4 and FY23 earnings conference call of Neogen Chemicals Limited. As a reminder, all participant lines will be in the listen-only mode and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Nishit Solanki from CDR India. Thank you and over to you.
Thank you. Good evening everyone and welcome to Neogen Chemicals Q4 and FY23 earnings conference call for analysts and investors. Today we are joined by senior members of the management team, including Dr. Harin Kanani, Managing Director, Mr. Anurag Surana, Director, and Mr. Ketan Vyas, Chief Financial Officer. We will commence the call with opening thoughts from the management, post which we shall open the forum for Q&A, where the management will be addressing queries of the participants. Before we commence, I would like to share a standard disclaimer. Certain statements made or discussed on the conference call today may be forward-looking statements. The actual results may vary from these forward-looking statements. A detailed disclaimer in this regard is available in Neogen Chemicals Q4 FY23 earnings presentation, which has been shared earlier. I would now like to invite Dr. Harin Kanani to share his perspectives. Thank you and over to you, sir.
Thank you, Nishit. A very good evening to everyone and thank you for taking time out to join us on Neogen Chemicals Q4 and FY23 earnings conference call. Hope everyone is keeping safe and in good health. We reported our financial performance on Saturday, 13th May 2023 and subsequently circulated the result documents. I hope you had a chance to glance through them. I will take you through the performance highlights, update on expansion initiatives and several developments that occurred during the period under review. FY23 was a landmark year for us. Not only did we report a solid financial performance, but also relentlessly worked towards executing several critical opportunities that would lay a strong foundation for our ambitious growth plans. We entered the year on a challenging note, mainly influenced by Russia and Ukraine conflict that disrupted the global supply chain and resulted in steep inflation in RM costs, utilities, and adverse movement in foreign exchange rates. I am glad that we stayed nimble and navigated through these pressures to report a healthy performance in a difficult operating environment. I would like to thank all our employees who displayed resilience and supported us in this endeavor. Let me quickly summarize some of the key financial highlights for the year. Revenues grew by 41% to rupees 686 crore as guided earlier, while EBITDA came in at rupees 112 crore, higher by 29%. Profit after tax stood at rupees 50 crore, an increase of 12% year-on-year. Performance was steered by incremental contributions from expanded activities and demand for strong lithium derivatives, favorable product mix change towards value-added products, as well as lithium prices. We continue to witness sharp volatility in input and logistic costs, volatility in pharma demand and lithium prices, which we were able to pass on to our customers with some time lag, thereby protecting the absolute earnings. For FY23, we reported 28% increase in organic chemical revenue, which was largely volume driven, while inorganic chemical revenue grew by 90%, a large part of which was on account of significant increase in the prices of lithium raw materials, and the balance was contribution by new customers that we added during the year. Having said that, RM prices linked to lithium have cooled off post Q4 and impact of which will be visible in the current year. I will now share some crucial developments that occurred in this quarter, which will steer our performance momentum going ahead. Firstly, we acquired 100% stake in Bewley Chemicals India, which owns the technology to manufacture N-butyl lithium and other organolithium products using lithium metal. This acquisition was completed on 3rd May 2023, pursuant to which Bewley Chemicals has become a wholly owned subsidiary of Neogen Chemicals. The acquisition is expected to significantly boost Neogen's portfolio by offering lithiation reaction to existing customers as well as new pharma and agrochemical customers. In addition, this In addition to this, we will further strengthen and help scale up the advanced intermediate and CSM manufacturing business. Secondly, in a major development, we signed a landmark agreement with MU Ionic Solution Corporation Japan, MUIS, a Mitsubishi Chemical Group company, to acquire technology license for manufacturing electrolytes in India. This is a historical development for us as MUIS, a global leader in electrolyte manufacturing, has issued its first ever license to anyone in the world, and they have chosen Neogen Chemicals. This will bolster our growth initiative in the battery chemical space. It will ensure that our electrolyte plant meets the stringent global standards for quality, reliability, safety, and efficiency, while helping greatly in reducing the approval time for lithium-ion battery makers. Both these developments are a testament to our promise and commitment towards building a solid foundation for the future. I believe this will significantly strengthen our competitive position in the market as we expand our R&D prowess across several chemistries to offer deep value to our customers. Moving to our expansion plan, our capex initiatives are underway and well on track. We have increased our reactor capacity for specialty organic chemicals by 31 meter cube in Q3 and Q4 FY23, and additional 29 meter cube will be added by September 23 as per earlier plan. Within inorganic chemicals, we completed the expansion of our lithium salts to install up to 2,400 metric ton, which is coming from 30 meter cube of reactor volumes by March 2023, 1 quarter ahead of schedule. For battery chemicals, the new capacity for 400 metric tons per annum for manufacturing specialty electrolyte salts and additives will be commissioned by June or July 2023 as per earlier guidance. While manufacturing plant for 1,000 metric ton of electrolyte at Dahej is also expected to be ready by September 2023 as per our earlier guidance. Further to this, we have started basic engineering work for the expansion project announced in the previous quarter, and the same is being planned in a phased manner. However, post our announcement with MUIS, some of these projections around battery chemicals, including the capacities and revenues, will change, and we will come back to you in couple of quarters to share further details around that. Our planned efforts to increasing the contribution of advanced intermediate and custom synthesis and manufacturing is on right track, and we are witnessing higher contribution from value-added products that require multiple steps. In line with this, we are strengthening our R&D competencies. During the year, we added 82 new customers, which contributed 7% to our revenue, both within India and globally, taking our total customer tally to almost close to 1,550 customers. In advanced intermediates, 1,500 customers. Currently, we have totally 245 products in portfolio and additionally working on 25 new products in our R&D, which has a potential future demand potential of almost close to around 2,000 crores. Let me conclude by saying that we are prepared to embark on the next phase of expansion, showcasing our proficiency in multiple intricate chemistries and manufacturing capabilities at a larger scale. The demand situation remains favorable, and our goal is to sustain this profitable path of growth. That ends my opening thoughts. I would now request our CFO, Mr. Ketan Vyas, to share financial highlights for the period under review.
Thank you, Dr. Hari. Good evening, everyone, and welcome to our Q4 and FY23 earnings call. I will take you through the key financial highlights. Please note that these are on standalone basis and based on year-on-year comparison. In Q4 FY23, revenues grew by 30% year-on-year to rupees 203.9 crore, and FY23 they grew by 41% year-on-year to rupees 686.2 crore. The company achieved its highest ever revenues driven by higher contribution from expanded capacity, consistent demand situation, and a positive shift in the business mix towards value-added products. Organic chemicals saw revenue growth of 39% year-on-year at rupees 138 crore in Q4 FY23, whereas inorganic chemicals revenue increased by 14% year-on-year at rupees 66 crore. In FY23, organic chemicals saw a growth of 28% year-on-year at rupees 463 crores, whereas inorganic chemicals grew by 80% year-on-year to rupees 223 crores. The domestic and export mix for Q4 FY23 stood at 55% and 45% respectively. EBITDA increased by 22% year-on-year at rupees 32.6 crores in Q4 FY23 and 29% year-on-year at rupees 111.6 crores in FY23. The company managed to achieve better EBITDA performance even though there were considerable fluctuations in input prices, utility costs, and adverse forex movements. This can be contributed to a positive shift in the product mix. Although there was increase in cost components, it was broadly in line with expansion of revenue, and when viewed as a percentage of overall revenue, the cost remained stable. Coming to the PAT performance, for Q4 FY23, it stood at rupees 14.3 crore, and in FY23, it increased by 12% year-on-year to rupees 50.1 crore. The company's PAT performance remained robust despite several challenges. The finance costs were higher due to ongoing expansion initiatives and higher interest rates compared to the base year. Moreover, the depreciation was high related to incremental reactors added during the year, which has not yet reached full utilization yet. Net debt after including current maturities of long-term debt stood at rupees 265 crore in FY23. Premised on strong performance during the year, the Board of Directors has recommended a final dividend of rupees 3 per share for FY23, subject to shareholders' approval. Those were the key financial highlights. I will now request the moderator to open the forum for Q&A session.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. We have a first question from the line of Saurabh Kapadia from Sundaram Mutual Fund. Please go ahead.
Yeah, thanks for the opportunity. So first question on the Boli chemicals. So is there any seasonality in the business, or the revenues will be equally distributed in the quarters?
Hi. So whatever we have seen so far, this should be more or less uniform because it goes to pharma customer. However, the Bulychem people were actually focusing only in the India market, whereas we have an opportunity to also sell this internationally in markets such as Japan, Korea, and Europe. So we are still not yet aware if there is a seasonality or if the revenues in the international market would be a bit lumped depending on our business development activity. But at present, we can estimate that, let's say, maybe this quarter we just completed the acquisition and now getting ready to start operations, importing the raw material and other things on our own. But from Q2, Q3, Q4, you should see more or less uniform revenues coming in.
Okay. So what is the utilization level for that plant, and what would be the peak revenue what we can achieve from this current capacity?
So this N-butyl lithium is heavily dependent also on lithium prices. So subject to lithium prices, it will be somewhere between 50 crore to 125 crore kind of a revenue potential, depending on how much lithium prices move forward. For the current year, I expect, now lithium prices have cooled down a bit. So I expect somewhere around 50 to 75 crore revenue contribution coming in additionally from this business.
Okay. So coming to our business, so what's the utilization levels for the organic capacity, and by when we should reach optimum level?
So, at our peak utilization with our existing installed reactor capacity was somewhere around 150 crore and 150 crores per annum, and we are at around 130, 135 crore kind of revenues as you've seen from our results. In addition to that, our new reactor capacity is coming online. So with this new capacities coming online, we should be somewhere around, the total peak revenue potential would be 175, 180 crores per quarter kind of organic revenue potential. However, I think our capacity is coming online by September, and maybe sometime in FY25 we can reach this peak revenue potential of let's say close to around 175-180 crores sometime in FY25.
Okay. So lastly, on the working capital, so now if you look at the working capital has further deteriorated compared to last year. So how we should look at improvement, by when that improvement will come through?
So basically, as we have stated in our last two calls, that like we were going through a significant change and increase in our capacity, increase in product mix, and due to that there was a higher working capital requirement, especially when we are getting the capacity to full utilization levels. So if you see, for example, our inventory increased drastically from almost 189 crores in March 22 to 282 crores by September 2020. And in that first 6 months, we did a revenue of around 300 odd crores. Now in the second half, we increased it further from 300 crore to 400 crore, but the inventory has remained more or less stable. So basically, to sustain the current level of business, we need somewhere around 280 to 300 crore kind of inventory. But as our utilization improves and as we reach our peak revenue potential, in terms of number of days, we would improve. It's our target that, so if you look from even September to March, we have improved almost by 25 days. And by, let's say, by FY24, our target was to reach inventories levels of around 120 days on net sales. So we will again target the same, that by FY24, we will reach peak utilization in our Dahej and other facilities. And we hope to reach about 120-125 days of net on the net sales basis inventory levels, more or less similar to what we had in FY21.
Okay, thank you. All the best.
Thank you.
Thank you. We have a next question from the line of Nilesh Kuge from HDFC Securities. Please go ahead.
Hi, sir. So my question is on the tax rate. So in our earlier conversation, you guided that for FY23, the tax will be in the range of a 25 plus or 20% plus or minus. But if I look at FY23 number, the tax rate is about 29% plus. So can you guide us on how the tax rate will be in coming years?
Yeah, so with higher, so we have completed majority of our capex in Dahej, and when we do like a higher capex, it creates that additional depreciation, etc., which does not give us a tax level significant profit, which is basically contributing to a higher tax rate. So since we have now completed majority of the capex in Dahej in Neogen chemicals, and now we have only limited capex remaining, our expectation, and with Dahej now reaching full utilization levels, over next 2 years, we expect to first start around 22 to 25 and then later on move to 20 to 22% tax rate over let's say next 2 financial years. This is our estimate based on our current projections for Dahej.
Okay. And on the guidance, on the top line guidance, I know that you continuously guiding us on FY24 top line, but with the recent acquisition of this Blue Lithium, 100% acquisition. So can you just guide us on the FY24 and then FY25 top line number?
Sure. So I think, originally, if you remember, our FY23 guidance was around 600 crores. And we have done 686 crore, but that was mainly driven by historically very high lithium prices, which is what we basically passed on to our customers. So if I were to do a correction of that, we would be somewhere closer to 600, 615 crores in that range. Now, in the current year, we have currently seen the prices have reduced drastically and come down very close to what the original prices were, although they are still higher than the original prices. So therefore, we estimate, so previously we had given around FY24 target of around 750 odd crores of revenue. So with the acquisition of Bulychem, what we estimate is at least 825 crore kind of a revenue coming in on the stable lithium prices. And depending on how the lithium prices fluctuate above, it might be somewhere closer to around 850, 875 or in that range. Basically what we are looking, if we remove the lithium price correction, we are looking at a 25 to 30% growth in our regular business, including the Bulychem business. And similarly on the EBITDA also, we expect around 25 to 30% increase over our current year revenue, our current year EBITDA performance.
Okay. So that means
the exact top line will depend upon how much lithium fluctuates during the year.
Correct. Absolutely. So is my understanding correct? Just correct me if I'm wrong. See, from the current, as you mentioned in your initial comment that lithium prices are already, they corrected but still on an elevated level. So with that current lithium prices, you are guiding 850 to 860 for your base business, for the ex lithium?
No, I was saying, see, our base business was supposed to be around 750 crore on stable lithium prices.
Okay.
Okay. So with Bulychem and with some slightly elevated levels of lithium, it will be somewhere in the 800 to 825 crore range. Okay.
Mm-hmm.
And again, if the lithium starts moving up significantly, then it might reach somewhere around 850, 875 crores in that range.
Okay. Thanks a lot, sir.
Basically, on the stable lithium prices, we would estimate a 25 to 30% increase, and on the base prices, on the base revenue of around 600 crore, as well as 25 to 30% increase on our EBITDA levels.
Oh, thanks, Arun.
That is for FY24, and for FY25, again, as we reach full utilization levels by FY25-26, as we have given a guidance, depending on the price of lithium, we should be somewhere between 900 to 1050 crore. And of course, this is based on the capex which we have committed till now for our regular business and Bulychem. Basically, we consider Bulychem as a part of very similar to our existing business, because the end usage industry is pharma, agro, and similar to that.
Okay. And just one clarification I need. See, you mentioned that you will again revise your capex for your electrolyte maybe after 2 quarters. It's a correct way?
Yeah, I think maximum within 2 quarters we should have a clear idea on the capex, how we are going to phase to the 30,000.
Okay. And after that, you require minimum 18 to 24 months to put up the plant and facility up and running?
Yeah, so after that, we would require somewhere around 15 to 18 months.
Okay. Thanks, Arun.
Thank you. Ladies and gentlemen, to ask a question, please press star and 1 on your phone now. We have our next question from the line of Sabyasachi Mukherjee from Bajaj Finserv AMC. Please go ahead.
Yeah, hi. Thanks for the opportunity. So my first question is on the gross margins. So if I look at the gross margins for the current quarter, you have been doing 43-44% gross margins in Q1, Q2, Q3, but it dropped to 40% levels. The inflated prices were there in Q1, Q2, Q3 as well. I understand that the maths, but what is the exact reason for this dip, and how should we look at gross margins going ahead?
Sure. So, one is, yes, the main contributor for this is the peak lithium prices, because lithium has its peak price in December, Jan, which is what the inventory that we consumed by March. So that was one of the factors driving that. And, historically, as we have said that previously we used to always say our gross margin is 40 plus or minus 2%. And in the last call, what we had said, we see it now more like 42 plus or minus 2%. So it's kind of moved that 2%. So depending on the year on year or quarter on quarter, and again, gross margin and the advance and the manufacturing cost goes hand in hand, because depending on the product mix, some product have slightly better gross margins, but then the processing cost could be higher. So overall, we had said there's a 2% shift on that, and we maintain that. It will be like 42% plus minus 2% in that range, in a normal case, barring some large movements in lithium prices or other raw material prices.
Okay. So there is a comment on the press release as well as in the presentation that you have seen a noticeable shift in the share of value-added products. And if I just adjust the revenue of 686 to let's say 600 or 615 that you have been saying, just eliminating the inflated part because of the lithium prices, your gross margins of gross profit of 298 crores on a base of 615 translates to a gross margin of 48% and EBITDA margin of again 112 upon 615 is around 18%. So on 615 crores, this gross margin looks very elevated, and the shift of value-added products, the CSM business, if you can guide, whether this is sustainable. I mean, 47-48% gross margin. Are we looking at those margins in the near term?
No, so there are few molecules which give us that, and ultimately we'll see. I feel this high lithium prices is going to be like maybe 1 or 2 years more, then it will kind of stabilize. But based on whatever I see now, I look at around 42, my guidance would be 42% plus minus 2% would be the gross margin we should look at in the near term. Till we have a certainty of a gross margin better than that, we'll let you know.
Okay. My next question is on the lithium salt and electrolyte. Just wanted to know about the manufacturing process. I understand that we will start with lithium carbonate that will import. But if I look at LiPF6, what are the other key raw materials? And if fluorine is a raw material, then how are we, how is our readiness in terms of having fluorine or a HF plant? Are we thinking of getting an HF plant? The thought process on that.
Yeah, so for the other raw materials also, they are domestically, and we worked with some of the domestic producers, sometimes multiple of them, and basically have basic understanding in place for a long-term supply contract or supply security with them. We can get into the final contract just like we can do with lithium once our customers start signing up long-term contracts. But we have already reached an understanding with suppliers of other raw materials of HF and phosphorus raw materials required for making LiPF6.
Okay. Lastly, my question on Bulai Chemicals. If you can please explain this need of this lithiation reaction and the use case, because if it is one of the few plants just outside China and Neogen has now access to it, why the revenue is so low, just 82 crores, and that also I believe because of the inflated lithium prices. What is the kind of revenue potential you see next 2 to 3 years from this?
So, you have to basically remember that the existing plant which was set up by Livent, and Livent had its own plant in US. They had a plant in UK, they had a plant in China, and this was their fourth plant. And originally they set it up in India as a trial facility with a plan that they will expand it in future, but as the India demand picks up. But currently they basically kept it at the level. So when it was live, they had multiple locations worldwide which were taking care of the world demand, and this was only based upon India demand. So currently, when we start with this plan with the existing capacity, as I said, depending on the price of the lithium, it can be somewhere between 50 to 125 crores kind of a revenue potential. Now we are trying to do things to debottleneck, to get additional production permissions, or other maybe also in future consider expansion if needed. But at present, with the capacities which are in place, this is the revenue potential.
And what would be the margin profile of this asset?
Again, it goes more a little bit on absolute terms, just because, like I said, price of lithium is one of the key contributors. So lithium metal is even more expensive than lithium carbonate. In a percentage point of view, the percentage varies quite a bit depending on the lithium prices. However, we feel, we should be able to get existing EBITDA levels or better in that. And also, as we operate this more, we should be able to give you a better guidance on what is the future revenue potential. We are also exploring, as I said, international markets, not just domestic markets. So we will also see, it's again a complex commodity to ship worldwide. So let's do some more trials, understand, and then we can give you further better guidance on that. However, the main interest that we also have is if we can use this for making more complex or more value-added advanced intermediate. So basically, we also hope that a significant portion of this is consumed in-house by our Dahej unit for the lithiation reaction, and that will allow us to increase the contribution of either CSM or advanced intermediate, and basically be the stepstone on which, or basically the foundation on which we can plan our future growth. So just as we have been using our expertise in bromination and Grignard, with this we are becoming better expert of lithiation, and then that will allow us to attract more projects related to lithiation, and therefore have a more long-term growth, one more long-term growth area where we can base our future expansion and growth in our regular pharma and agro business.
Got it, understood. That is very helpful. That's all from my side, and all the best. Thank you.
Thank you.
Thank you. We have a next question from the line of Sudarshan Padmanabhan from JM Financial PMS. Please go ahead.
Yeah, thank you for taking my question. So my question is to understand a little bit more on the organic, segment of the business. If you can talk a little bit more on, you talked about, the supply demand scenario being a little challenging post, the China issue and the Russia issue. So, on this side specifically, if you're going through sub-segments at pharma, non-pharma, are we seeing any kind of, a weakness in terms of demand, in the sub-segments? And second is on the supply-demand scenario. We have actually seen a kind of a fair amount of a volatility in terms of end prices as well as raw material prices. I mean, if I'm just taking the, kind of guidance of, either Albemarle or ICL, I mean, they have called out for near-term weakness on, it might not be apple to apple, but believing that the near-term inventory gap would be allayed from a longer-term perspective. So just wanted, your thought process on, the raw material prices as well as your end products.
Yes. So, we've seen lithium prices, as I mentioned, reach the peak in December. And then even January was a bit uncertain, but from February, March onwards, we have seen a step-by-step decrease. And we feel we even saw at least the near-term bottom in April, and then now again we are seeing lithium prices and other prices again pick up. But again, we don't know whether that will sustain, and if it again goes back, because it's very difficult to predict. like mainly what we feel is that, just as India worries a lot about all its imports and especially oil as imports, lithium at those price levels and with the contribution, with the amount of business which happens for lithium and batteries in China, China's import bill was also going very high because of the high lithium prices. And I think the country as a whole seemed to have done collective inventory correction, to put pressure on lithium miners, and we believe that is what corrected the price. But whether they can sustain that, because the demand for the EV, the demand in the US for electrification, for energy storage continues to remain high. So ultimately, I feel again in near term, the prices should again move up for the next 2 years, and it, like I said, the next 2 years is going to be volatile, and after that it should stabilize on a long-term new lithium average price. So this is my view on lithium.
On the bromine side, I was referring more on the bromine side, since you've already commented on it.
Okay, on the bromine side, what we have seen is that, worldwide, like the flame retardant market, especially in China, has become weak. So as you said earlier in our call, 90% of the bromine gets used for the bulk bromine usage. So at least from what we can tell or what we've gotten the feedback, that the flame retardant market in China, the demand of flame retardant has reduced significantly. Part of it is because ICL and Albemarle have increased the capacities, and part of it is just a lower demand because less exports are happening in the international market with the weak climate worldwide. So because of this high FR inventories and low FR demand, the bromine prices have corrected significantly. So that's been the major reason, in my view, for the correction in the bromine prices.
And I mean, would we be able to take advantage and lap it up? I mean, because if the inventory correction happens and the demand picks up, it could go up. So I would assume a part of the working capital would be towards this asset, right?
Yeah, so our aim always is to basically pass on the benefits as well as the pains to the customer. So in this case also, we would not look at benefiting from it, and historically also we've been able to pass on. If we have some inventory, majority of this, we are able to pass it on to the customer and make sure we average it out or something. So you might have some Q1, Q2, you may see some fluctuation, but overall when I look at the whole year, we should be more or less okay.
And on the demand side, on the organic side, given that again, on the non-pharma side, we are seeing some kind of, mixed commentary, that there could be lower prices and, higher inventory, etc. Thanks to the things that's going around. How do we see the demand for pharma and the non-pharma part, for the year?
So overall, we do see there's a slight demand weakness. There's more Chinese competition. But this is where, what we have shared with you historically, that at Neogen, we always believe in having a visibility for a large number of business and then keep moving from one product to another. So if we see slightly weaker demand in one product, we then move on to another. And also we are constantly having a pipeline of new products. So even last year, the completely new products contributed to almost 7 to 8% of our revenue, which we made first time, 7 to 8% revenue coming from new customers. So these are the customers with whom we did business for the first time. And similarly, completely new products also contribute to more than 10% of the revenue. So we keep, the fact that we are not dependent on a single molecule, and we have multiple products, and we have pipeline more products and customer approvals. So that basically ensures that we can protect our margins even when demand is a little bit weak or a competition is a bit more severe.
Thanks a lot.
Thank you. We have a next question from the line of Rohit Nagraj from Centrum Broking. Please go ahead. Mr. Rohit Nagraj?
No.
I'm sorry, we cannot hear you. No, sir, we cannot hear you. Your voice is sounding muffled.
Yeah, is this better?
Yes, please
Yes.
go ahead.
Yeah, thanks for the opportunity. I was just taking the earlier question forward. So you mentioned that for next couple of years we'll be having 20 to 25% overall growth. So what are the user segments that we are looking at from a growth perspective for both organic as well as inorganic business?
So in the organic business, we continue to do pharma agro, and as you mentioned earlier, we are seeing also good traction from flavor and fragrance industry. So we might have some contribution coming in from them also in the future. So these are the three areas for the organic segment. And on the inorganic, we added, as I explained to you, like, in our non-battery lithium application also, we added several new applications of lithium salts related to ceramics, related to some specialty water treatment applications and others. So and also we sold more quantities internationally for the engineering or the vapor absorption industry. So I think this international vapor absorption and the new industries that we added, they will continue to remain a growth driver in the non-battery lithium, and also battery materials will keep adding as our plant for electrolyte salt and electrolyte will come online the current year. So this will be like some small, revenues and some small sales which we will be doing of this. But the larger increase will come from, let's say, FY26 onwards, when the majority of Indian chemicals are likely to start.
Right. So this 20-25% growth in legacy business is predominantly a volume driven.
Yes. So actually I said 25 to 30% in the next year in FY24. But yes, that's from the legacy business.
Yeah. And second question is on the Mitsui collaboration. So will we be having access to the recipes as well, apart from the technology access?
Yes. So actually it's Mitsubishi, not Mitsui. So it's an agreement with MUIS, Mitsubishi Chemical Group Company. Yes. So currently the agreement is for manufacturing technology, and we also have access to the recipes, but the recipe agreement will be combined because the customer has to choose it. So it will be Neogen customer and MUIS will work together that which recipe is beneficial for that particular customer's design, and if the customer so chooses, in that case we can use the recipes in the new plant.
Yeah, my apologies for mentioning Mitsui instead of Mitsubishi. Just one clarification. So effectively, in this case, they will have some royalty payment.
When we use the recipe, there will be a royalty payment.
Fair enough. That answers my question. Thanks a lot and best of luck, sir.
Yes.
Thank you. We have a next question from the line of Aman Vij from Astute Investment Management. Please go ahead.
Good evening, sir. My questions are on the electrolyte business only. So, if you can talk about where are we at this stage? Are we through the lab testing stage? Are we through the validation stage? Or are we at the qualification stage? And if you can also talk about what is the number of customers we have given the samples and all those things.
Sure. So, we currently have, like in the past also shared, we work with 15 to 20 potential cell producers who want to produce or who plans to manufacture cells in India. Like many of them who have an ability to test the samples have taken our samples and have started approvals. Some customers have completed first chemical evaluation and then moved on to electrochemical evaluation, and now some customers have even initiated like a small actual line trial. So instead of just testing in a lab, they are actually going to make, let's say, a few thousand cells with it and do the trials on that. So That also is some, again, in actual is the capacity of what cells they can make today. So more or less our electrolyte production scale is happening to match as our customer gets ready. We are ready before the customer demand exists. In fact, our September, what we are planning, the electrolyte plant to start 1,000 metric ton. So that can also support 1 gigawatt hour kind of a cell, 1 to 2 gigawatt hour of cell production. So even that also will be ready much before the customer demo plant starts.
Yeah. So I wanted to understand that part only, because if you want to sell 10,000 tons or eventually 30,000 tons, will require India production capacities of somewhere between 10 gigawatt to 30 gigawatt hours. So are you saying these kind of capacity will be present in India in the next 1-2 years or maximum 3 years?
Yes. So as I explained to you, in our answer to previous question, that we already had a plan and we already have a plan to reach up to 10,000 metric ton, which was announced before MUIS agreement. Now the license that we have with MUIS, we can increase up to 30,000. So already 1,000 was already put in motion. So 1,000 we are not stopping and we are going ahead and completing that on track. But we have some time to decide or fine tune our 5,000, 10,000 and 30,000 ultimate what we want to reach answer. So that is what we are currently fine tuning, that when the 10,000 will happen, when the 30,000 will happen. And that is what we said we'll share in next 2 quarters. And as our previous question when I answered, it is 2 quarters for finalizing the plan. And then after that, it is around 15 to 18 months maximum of build time. So within next 2 years, technically we can be even ready with 30,000 metric ton.
Sure, sir. On this agreement which we have with MUIS, I think you had mentioned clearly last time that there is some kind of restriction for us to export outside India, or we have to take permission.
Yes.
I just wanted to understand your thoughts, because if we already had some kind of technology, and my understanding is export opportunities in US, and there is a lot of big opportunities coming which wants to look at China +1. So by coming into that agreement, any reason we are leaving out such a big opportunity, and only domestic is obviously good and it will also grow, but why leaving out a much bigger business outside India?
So I think Neogen strategy was very clear that, lithium salts was an international opportunity, because that's an investment which we can do internationally anywhere. Okay. And that's something which we are still looking, and we feel that once our trial facility starts, there are many international companies with whom we have discussed, including MUIS, who are electrolyte producers and to whom we can basically supply electrolyte salts. Now, electrolyte business, Neogen always felt that we wanted to do it domestically because, there's a good domestic opportunity, and this business is historically done always localized because of the need for special tanks and logistical complexities. So therefore, since our focus for electrolyte was only for India, and electrolyte salt was international, and this agreement in any way did not stop us from both our focuses. So that's why we are okay with that.
Mm-hmm. Final question on this part, sir. The pricing of this electrolyte has gone up a lot, and then from $50-$70 to almost $15-$20 now, and maybe it's going up and down a lot. So are we thinking of entering into some long-term contracts so that our margins get protected? Otherwise, these kind of fluctuation might result in, I don't know how as a company we manage all those things. So if you can talk about our thinking in terms of long-term contracts with our potential customers.
Yeah, so we have seen that historically also most large volume users would basically do a long-term contract or at least a long-term kind of a price model. So we also worked on a similar, not similar, I would say a little bit less complex business on lithium bromide, and which we've done for last 30 years with engineering companies who basically want to use this as, let's say, 10% of their cost contributor. Just as in the cell production, electrolyte is also 10% cost contributor. So in some sense, it's very similar business, and even that also works basically on a cost plus basis and like with long-term understandings, where we did not insist on a long-term contract, but we feel because here we have to put significant capacity. So as our customers get more ready with their plans, we will enter one by one long-term contracts with these customers, and most of them should be such that our at least ROEs and ROCs are basically protected.
Sure, sir. That helps. Thank you for answering the question.
Thank you. We have our next question from the line of Yash Shah from Investec. Please go ahead.
Hello. Hi, Harin sir. Thank you for the opportunity. Sir, my first question was regarding our electrolyte capacity. So since we are already going to add 1,000 tons of capacity using our indigenous technology, will it be safe to assume that the rest 9,000, which we had formerly announced, or whatever the changes will be, the rest of the capacity will be from the new technology which we have acquired, given that we have acquired a global technology, we have the license for a global technology, and will not really require the indigenous technology anymore. So just wanted to know your views on that.
So again, exactly how we are going beyond 1,000 is something that has to be done based upon the timelines for implementing the international technology versus the timelines of my customer requirement and what solutions, if at all, intermediate is required. So this is what Yash will share a little bit more clearly over next 1 or 2 quarters, that how we are going from 1,000 to 30,000.
Got it, sir. Got it. Sir, my second question was regarding the same tie-up which we had with MUIS. This has given us a significant advantage as compared to our peers or the new entrants who might want to enter into the segment. So just one question was that what was the reason we did not enter into an exclusive contract with them? What were the bottlenecks on that front? The reason I'm asking is because maybe the peers could also enter into some kind of a similar agreement with the other players, not the same ones, with the other players, say number 3 or number 4. So yeah, about that.
So, it was basically, this is the first time ever where MUIS basically decided to open and share their technology with anybody outside of their group. So convincing them for that itself was a very task. But as a Japanese company and whatever we have seen whenever we work with Japan, whenever they give technology, they are very reluctant to get into an exclusive contract because there's always a fear that in case if there is a non-execution on the side of the technology recipient, then they kind of get bogged down. So this was something which was basically more like a Japanese wish, our MUIS's wish, which we had to agree on. Although there's a strong understanding that they will always work in such a way that Neogen interests are protected, and their intention is that Neogen becomes successful, and hopefully we together can convince our customers to use MUIS recipes also, and they can have a future revenue source coming in from that.
Got it, sir. Sir, another question which I had was on the salt front. Even though we have mentioned in our presentation that we do not really intend to basically sell the salt outside, but then it is one of the options which we have. Wanted to understand your views on how do we basically expect to compete with the Chinese and the Korean prices on the for the LiPF6 or LiTFSI salts.
So in the presentation, we never said we don't intend to sell the salt internationally. We just said that the capacities that we have planned are mostly keeping in mind our Indian internal requirement because we don't have a number yet on the international demand. So our efforts are always to make sure to try to sell the salt internationally because that's a bigger market in general. In terms of competition against China and Korea, so majority of this is really China. Like there's very limited capacity in Korea and there's very limited capacity in Japan, and they are planning to expand very limited volume, which will not take care of the rest of the world's demand especially in Europe and US. So therefore, there is going to be additional electrolyte salts required. Now, some of that may come from new plants in Europe, new plant in US, although they will take longer than us because we have moved earlier, our demo plants are getting readier, so we would have the early mover advantage as well as lower cost advantage as compared to if at all any plants are set up in Europe and US. Now, as compared to China, historically what we had seen that between China and Japan, the price difference when lithium prices and everything else was stable was roughly around 20%. So we feel if a Japanese company also could make with a 20% higher cost as compared to China, maybe with our cost advantages, we should be somewhere around 10% or so more costlier, worst case scenario, as compared to the Chinese at a comparable volumes and levels. So we are basically banking on that, and we are also hoping that there is enough interest for a non-Chinese source from a de-risking point of view to basically get this 10% higher cost offsetted. And if you are able to do some process improvement or efficiency or give comfort on better quality, just as we do in our pharma intermediates and other intermediates, similarly we can justify the higher cost or with a process improvement reduce the cost and match whatever is the Chinese price. So this is the long-term view, but again, we have to start making salt first. First target would be to match the global expectations on quality, and then we would try to meet the other targets so that we can establish a good international demand for this electrolyte salts as well.
Got it, sir. Final question from my end. This was regarding our organic business, sir. From the last 2 quarters, we have been mentioning witnessing strong traction on the FNF front of flavors and fragrances. So has now with the return of China, have we been facing any kind of pressure on that front? Also, we had mentioned that we had 5 customers, which we had added 5 new customers in flavors and fragrances and agrochemicals and engineering segment. How many new customers have we added in FNF space throughout the year in FY23? And what do you see? How do you see the mix moving in the coming year? Like how much contribution do you expect from FNF?
So we don't have a number for you yet. The only thing we've seen good number of projects, and many are in the CSM space and many are in the advanced intermediate space. Basically, some places where they are transferring technology and some places where they are asking us to develop the molecule for them and then with a keen interest to buy these molecules. So all these projects are moving. So far we are at a trial volumes like 500 kg, 1 ton level, but we feel in FY24 it will move significantly. Although I would still say it will be clubbed in our other segment. I mean, it will not. I'm not expecting like a 10%, 15% because regularly our top line is growing. But yes, I mean, it's one more, we are building new partnerships, and over next 2-3 years, whenever we do our next MPP plan or a major expansion in organic area, this is one more area which we can bank on to provide further growth beyond, let's say, FY25, 26 kind of revenues.
Got it, sir. Thank you. Thank you for answering all my questions and all the best.
Thank you, Yash.
Thank you. We have our next question from the line of Omkar Kamtekar from Bonanza Portfolio. Please go ahead.
Hello, am I audible?
Yes.
Yeah. So, sir, firstly, I needed some granularity on the results. So, in the revenue breakup, we can see that 45% are exports and 25% as domestic. So, can you give us a region-wise breakup of how much of export is in specific area?
So we have not shared that, I think, since IPO days, but majority of our exports are consisting in Japan, Europe, some to USA, and some is deemed export, which is basically to SEZ and EOUs in India.
Okay. And in the revenue breakup of the inorganic organic segment, could you give user-wise breakup? So how much is for pharma, how much is for agri? Is that possible?
So usually pharma is between 50 to 60% in that range. It's been like that, and the agro business has been between 15 to 25% revenue contribution, and the engineering around 10 to 15%, and the remaining industries is about 5 to 10%.
Okay. Nextly, sir, wanted to know what would be the approximate expenditure CapEx that you would incur for the battery businesses. So we have told in the previous announcements also that we are setting up a wholly owned subsidiary and we'll be focusing on the battery business as one of the driving force for the growth. So approximate what would be the expenditure and over what timeline?
So we had shared in our investor presentation. You'll get a little bit more detail from there. But we had shared a revenue, a capex of approximately around 450 crores in our lithium-ion battery over a period starting from, let's say, we already have started and going up to, let's say, FY23. So over next 2 years period of time.
Okay.
But again, this is a number for 10,000 metric ton per annum capacity. So we'll again review this as we review our 3,000 metric ton.
Okay. So my actual point was I got the impression that maybe that 4,450 crores was up to the full say 30,000 metric tons. So I got the clarification for that.
Sure.
Thank you. That's fine.
Thank you. Ladies and gentlemen, that was the last question for today. I would now like to hand the conference over to management for closing comments. Over to you.
Thank you all the participants for joining the call. I hope we were able to address your queries. If you have any further questions, please feel free to reach out to our investor relation team and we will address them. Thank you once again. Stay safe, and we look forward to connecting with all of you again in the next quarter.
Thank you. On behalf of Neogen Chemicals Limited, that concludes this conference. Thank you for joining us, and you may now disconnect your lines.